Hi, I'm Brad.
I'm Meg.
And
welcome to the Millennial Report.
We've been going for a whole week and so much has happened, but one of the primary movements took place last week. Coming out of the Federal Reserve, the Fed for short is mulling its next interest rate increase after increasing rates in December 2015 for the first time since 2006. And without giving away too much of today's segment, the reason why this is important is because of how interest rates also affect consumer and business psychology.
Some of you may remember we previously did an episode featuring Jargon Words when dealing with brokerage services, and today we're joined again by Rachel Mayer, co-founder and CEO of Trigger Finance, the mobile service that helps you manage your portfolio by simplifying your investment ideas. Welcome back, Rachel.
Welcome.
Thanks, Brad and Megan, for having me again.
So to jump right in, I know we've got quite a lot that's happened with the Fed, and you're going to kind of hit us with some jargon words that we should know when kind of listening to some of these different reports and reading up on the Fed and all the happenings that are taking place.
Whenever you open the newspaper, there's always commentary on how markets are doing, on how the economy is doing, and usually it always relates back to the Fed, back to monetary policy. The Fed is basically using these policies to set the course of the economy and the course of interest rates. Mm-hmm. I just wanted to break down 5 keywords that you'll often come across in these press findings.
Awesome. Let's hit it. Number 1.
Number 1 is the Fed, or Federal Reserve. Some people, use it interchangeably. What is that? Mm-hmm. They're an independent federal agency, which means they have essentially complete freedom to do whatever they like with monetary policy. The central regulatory institution that regulates all financial institutions in the United States. The tools that they use to enact their mandates are, 1, setting the direction, of course, of interest rates. Mm-hmm. So when you hear the Fed saying they're going to raise or cut rates, that's them deciding on the interest rate outlook for the United States. 2, it's setting reserve requirements. So when your bank takes your deposit, some of that is set aside at the Federal Reserve Bank to ensure that there's enough liquidity in the economy, and it's a way to control the supply of money. And the third and most common way is open market operations. So a way to control how much money is flowing into the system is how banks lend and borrow against each other using government bonds. The Fed mandates, it's a tall order. It's to sustain considerable growth for the economy. It's to ensure stability and prices of things that we buy and use every day. And it's to ensure full employment. So if your task is to ensure full employment and control inflation,
it's not hard at all, right?
It's not hard. No, it's easy.
I actually did an internship for the Federal Reserve when I was first starting out. Yeah, I was at the Philadelphia Fed.
Oh, awesome.
And so one of the ways that I'm familiar with, at least from my perspective, was I was part of the survey taking. So I did the Business Outlook survey.
Yes.
I was part of that team. So that's one of the ways in which the Fed basically structures regional monetary policy, gets an understanding for different areas, because the Philly Fed, they cover just certain areas of the United States. So each of the Feds are located, in central areas, but of importance.
I didn't know that.
I know, I'm full of surprises.
I didn't know that either.
Always on camera.
Second jargon word, or woman rather, it's Janet Yellen.
It's been very interesting to watch a woman in that role.
Exactly.
And I've really, I was very inspired by her selection.
Me too.
And I continue to really enjoy watching, her perform as the Federal Reserve Chair.
She is, in fact, the first woman to serve ever as chair of the Federal Reserve, and that's a big deal.
Yeah.
This is a position that is up there with, the president, is up there with, chief of the International Monetary Fund. Everything she says, everything she does, every single movement, every single action is analyzed completely. Because everyone wants to know what the Fed is going to do because of how it affects the economy. She's just hitting her stride in terms of how early she is in her term. These terms last for 14 years. Because as an economist, you need time for these policies to pan out. So when you hear Janet Yellen and all of the puns associated in the news, she is the big kahuna. And markets and analysts and everybody listen exactly to what she says. The third jargon word is FOMC. FOMC stands for Federal Open Market Committee. It's a subset of the Fed, so the 7 Board of Governors and a couple of presidents, like the president of
the Philly Fed.
They rotate. They're a committee that essentially sets the direction of monetary policy. They meet 8 times a year. It's super secretive meeting. They meet in DC and they convene for 2 days. And what they talk about is what they're seeing, the research, the economy, and they set the course of interest rates. So when they say FOMC is happening, that's when the decision is being met to decide where interest rates, how many bonds they're going to purchase, and to offer general commentary on how the markets do. So the next meeting is June 14th to the 15th.
I think I could have splashed that invite to that one.
Yeah.
Did it come from you? It came from you,
Maybe, yeah.
Oh,
I
yeah.
mean, Yellen's my buddy, so yeah.
Homies.
We're homes.
That's cool.
But seriously, this meeting is so cool. June 15th at 2 p.m., there'll be just a blank statement that says, this is what we discussed and this is the interest rate. And that's what moves markets. We all know that rates have been low for 9 years, and in December you said that the Fed raised rates. So in this next June meeting, there's big, hot debate of whether that rate will increase because of what Janet has said in the past week. The 70s, 80s, and 90s, there was another jargon word that's not covered today, but it was called Fed speak.
Okay.
And it was essentially just a very convoluted way of describing nothing.
Okay.
Nobody wanted to give away what they were talking about. Nobody wanted to spook the markets. And so they would, talk about weird things in different ways. And that's completely different from what we've seen these past few years with Ben Bernanke and Janet Yellen. They're very clear with their intention. And so transparency is key, and it's a good thing for the Fed. The fourth jargon word is the federal funds interest rate. It's how banks lend to each other overnight. So the reserves that are held against their deposits, there's a mandate as to how much they can have. And so banks lend to each other overnight to basically promote offshore lending of what they have. This is the base interest rate that we all know that essentially trickles down into the economy. Because it's more expensive for banks to lend against each other, then in turn it'll be more expensive for you to borrow against the bank. Mortgages, credit cards, auto loans, student loans, it all comes down to how banks are borrowing or lending against each other to ensure their federal reserves against the Fed. So when the Fed raises interest rates, that's a way of tightening the monetary supply, going back to macroeconomic theory. So it's more expensive for the banks to borrow, and in turn they'll held up more of your deposits and lend less to avoid paying so much in interest.
We've got a millennial audience that perhaps may be in college, getting out of college, or paying off student debt right now. How does something like this affect them?
So yes, higher interest rates will eventually trickle down into their student loans and into their credit card loans. But that will take time. It's not immediate. It takes a while for banks to organize all of their products. So even if in 2 weeks the Fed does raise interest rates, it's not a cause to freak out anytime soon. Take in mind that the base rate we're talking about is already super low. If they raise rates, it'll be from 0.5% to 0.75%. So still less than 1%. Low rates for 9 years, we weren't big earners during those 9 years. We were in college. And so we weren't able to afford the house or to afford actually consumer spending and purchasing. We can't really afford, to save. We can't really afford to spend. So we're in a tricky position. And you hear a lot of people talk about like wage growth. Like that's what really matters. It's not the interest rate, but the relative growth of how your salary is increasing. The final jargon word that you'll definitely hear in the press, and it's a pair of words. It's hawkish and dovish.
Oh yes, that's a good call.
These are really good.
Yes.
That's a good call.
I like that reaction.
Like, she's a hawk, she's a dove.
Go, Rachel.
So hawkish and dovish is very similar to bullish and bearish. Except bullish and bearish applies to prices and stocks. Hawkish and dovish applies to rates. When people say you are a hawk, it means that you favor higher interest rates to combat inflation. And it's usually to the detriment of growth and full employment. If you're a dove, conversely, you prefer growth and employment over inflation, and you tend to favor lower interest rates. But these words are used all over the news. It's also relative to something else that happened. So take example of the FOMC when the statement comes out every month or so. just because they changed a particular wording in paragraph 3, that means that the statement has now turned hawkish from dovish. Once somebody yells hawkish on the trading floor, that's when, you know, bonds sell off and the market sells off, and it just changes your perspective.
Wow.
So there are two very jargony, important words to understand.
Yeah.
Important.
So you have some very exciting news.
Yes.
Yes.
So Trigger Finance is launching publicly to the market. And this is our bread and butter.
Yeah.
We trigger on these events.
Okay.
We can trigger on the Fed. We can trigger on employment levels. We trigger on all economic indicators that move markets.
Perfect.
And we put them in a way that a millennial audience and a retail investor can understand it. If GDP comes above expectations, I want to buy, you know, stocks because I think the market's going to do well.
Yep.
We think in if this then that statements, and as to relate it to the economy, break it down. You know, it doesn't have to be some convoluted way of thinking. It's just if this then that.
Yeah.
And so in Trigger, we have a code for you to download in the Apple Store.
Sweet.
It's
You want to get your pen out?
My handy pen. I feel like no man sometimes.
So Trigger Finance, if you search in the Apple Store and you create an account with referral code Nasdaq.
Nice.
Yes, Nasdaq.
I know people who work there.
Hey.
Oh.
Oh, it's not even in the camera shot.
Oh, I'm
That's
sorry,
cool.
Brad. We'll fix that.
In the Apple App Store, search for Trigger Finance, and you can download it and use referral code NASDAQ to create an account.
Nice.
Done deal.
Well, thank you again, Rachel.
Thank
you so
you.
much. It's so great to have you
Yeah,
here.
thank you,
Great to have you here,
Megan.
Love
Rachel.
when you
Brad.
come by.
Likewise.